Welcome to your welcome. Um, have you always wondered why we have what we call the breakout in trade? Now, breakout are actually as a result of range, and most people usually run away from trading breakout or range because it's quite confusing, and they are yet to understand the nitty gritty and psychology of trading range break. Now, the breakout of range. I quickly want to show us um, a strategy, opening range breakout strategy, how we can actually trade the opening breakout of an instrument. Now, before I do that, if you have not subscribed to this channel, do well to subscribe to the channel right now. Click the notification bell so you'll be notified whenever I upload a video such as this. Now, in my video, I will be doing both the theory and the practical, theoretical aspect and the practical aspect. Now, follow me gradually as I unveil unto you this secret trading strategy that I have been using for the past 10 years in the Forex market, the opening range breakout strategy. Now, I want us to first of all understand that not all times of the day are equal for active traders. Not all times of the day are equal for active traders. Now, when the market opens, it's one of the best time for traders to actually trade because when the market open, immediately there is increase in volatility and liquidity. Now, apart from the opening of a market where there is actually a confluence in the sections, that means there is actually an overlapping of the sections, is actually the time second best time for traders to trade. So you need to put this at the back of your mind and understand it so that you won't be left out. Now, I will later on come and show us the practical. Now, you need to watch this video completely so that you'll be able to understand what I'm teaching when it comes to the practical. Now, not all the times are actually good. There are times that are the best. Now, I'm just telling us that there are two best times now that you can trade to make profit, maximum profit. That means the opening of a season and then the overlapping of a season. Um, Asian section overlapping with the London section overlapping with the New York section. So those are actually seasons whereby you can actually make profit because there is increased volatility and liquidity in the market. So not all the times are actually what equal to traders. Now, I want us to understand something, that the opening range breakout strategy is actually a strategy that focuses on identifying a specific price range and then the direction of the market after the market has opened. That is why I call it opening range breakout strategy. This strategy focuses on identifying a specific price range and then the direction of the movement of the market as it opens. Now, the goal of this strategy is for us to capitalize on the initial action of traders, market makers, institutional traders. Is for us to capitalize on their word and their moves, their initial move. Because when we understand the initial move of the market makers or the trade institutional traders, who will be able to make profit. Now, once we understand this, which is our goal, and I will be teaching us how we can understand it, then we're going to focus on our time frames. Now, our entry time frames is the 5 minutes time frame, the 15 minutes time frame, and the 30 minutes time frame. There are three time frames here that guarantees our entry. Three time frames. Then one of the key steps in order for us to trade the open range breakout strategy is for us to establish key levels. Key levels. Now, these levels are support and resistance levels. key levels, because these levels actually help us to know um our our entry also, and also our exit. Also help us to identify where the volatility is much more and which direction it is in the market, which we are going to be using the demand and supply zone in order for us to know that one. Then the key levels help us to know the previous high and lows, or the previous day high and lows, or the present high or low of that particular day. And then our target is for us to get a breakout and then hit the market. With this now, we'll understand that we must be able to draw a range. We must be able to draw a range as the market opens and the range is happening. We must be able to draw our range, and then we should confirm our trade with technical indicators. We have to confirm our trade with technical indicator, and then we now look for a signal candle which has to do with our volume candle, and look for the possible location or the place where we introduce our stop loss and take profit. Now, let me quickly take us through the practical aspect. Now, this it is called what? Range break strategy. Opening range break strategy. Now, this is an example of a range opening range break. This particular place. This particular place. Now, I am going to draw. I am going to draw a box that will be able to clearly define the range in this particular video. Now, this is the range. Now, this is the range that we have. This is the range that we have. Sorry, let me do it well. I need to tick. I need to tick. I need to tick so that I can be able to explain it well. Now, this is a range. This is the range. Now, price move in this direction for a long time. In this direction for a long time. And all of a sudden, there was a break now. There was a break. Now, just because there is a break in the direction of the trend does not mean you should enter the trade. Look at this particular thing here, which has to do with our confirmation. Now, this is the 15 minutes time. Look at this, has to do with our confirmation. It is at this particular candle. It is at this particular candle that we saw the introduction of the volume. The volume was introduced at this particular candle. Now, before then, let's look at the previous high and low. Let's draw the previous high and the previous low, because the previous high and the previous low will serve as a pointer to us. Serve as a pointer to us. So look at it. So you see, the previous high and low has been drawn. You see it here. This horizontal line. That is the previous high and low. Okay, let me make it more tangible. Let me make it more tangible. I think let me change the color. And look at it. This is the previous high and low. Now, no matter what happens, this is a bearish trend. We will not expect the price to actually pass, that's the present day price, to pass above the previous day high. Why? Because it is moving downward, it's moving bearish. That's one of the secrets of understanding what the previous day, what high and low. If it is going up bullish, we will not expect it to go downward beyond the previous day. Because it is bearish now, we will not expect it to go what above the previous day, because it is going for a what sell. It's making higher lows and lower lows. That is the wisdom behind it. Now, even in the previous day, we can look at the previous day. Let's take this to the next day. This is the high and this is the low. You discover that this is the high. Yes, you discover that even the high of yesterday, in fact the high of the previous day, could not, the present day which it is, could not go up to the previous day, and that's how it keep moving. That's how it keeps moving. You see, even here too, after this day, the high of this day could not go above. So that is just how price normally move. Put it at the back of your mind. That is how price normally move. So you having understanding of the previous day is enough. Now, um, one of the things that I always tell my forex trade students is that they need to focus on confirmation, signal confirmation, because it is a signal confirmation that confirms your accuracy in your trade. Your accuracy in your trade is based on the confirmation of the signal that you are actually having. And what are the confirmation? um your moving averages. Now, me, I have a TDI here, to confirm. Also have um moving average here to confirm. I normally use to more than two user moving average, at least three moving average. This is 50. I have moving average 13. I have moving average 13. I have moving average 13. 13. Moving average 13. Moving average 13. X, yeah, save. Not change the color. Let me change the color. Give it green. Yeah, leave it like this. You see, so when there is a cross in my breakout, and the cross you see is at this particular place, at the demand, the supply zone here. This is where the supply was done. Institutional trader supplied the finances, and then we saw it move down. Where there is actually, you see here too, this is a place here, the supply zone. You see it at this particular place. So once that you see 30 moving average crossing the 50 moving average, most time it is where there is the supply zone or the demand zone. So these are actually some confirmation. Now, if you need some more confirmation, check out my videos on YouTube, and you will see more and more confirmation to just one trade. You discover that I'm using more than 6 to 7 confirmation just for one trade. That's why I hardly use. Thank you for watching this video. Kindly do well to subscribe and give some comment and some thumbs up. so that I will know that I'm making impact in this side. Thank you so much. See you in the next video. Thank you for watching this video. Do like, share, comment, and subscribe to this channel for more information.